Hello there, this is topratedforexbrokers.com and we start the Forex strategies for beginners with one of the most interesting concepts coming from the Japanese approach to technical analysis. The most famous of the Japanese candlestick techniques, namely the hammer. The hammer is, above all, a bullish concept. For the hammer to fall, or if you look for a hammer as a candle, you must have a bearish trend. This is one of the simple things that many traders overlook as they look for the hammer as part of a small dip. You need to have a bearish trend, and the hammer represents a candle. It is a one single candle formation, and it looks something like this. You have the body of a candle, and then you have a very long shadow. It is called like this. This is the hammer. Now, the body of the candle, let me just change it here like this. The body of a candle may be green, it may be red, bullish or bearish. It doesn't matter. What is important is the shadow. This price dip that was aggressively bought by bulls. Why? The hammer shows the battle between bears and bulls. You have a very strong trend, but at some point or at some level, there is a technical or fundamental reason that bulls come to join the party and they try to take control of the bearish trend. So it represents a fine. Therefore, it is said that the stronger and longer the shadow is, the more powerful the candle is. With the one candle reversal pattern, the hammer is quite powerful. Unfortunately, it doesn't appear that often on the charts, but when it does, we should be smart enough to trade it as it is. Now, because it represents a challenge, it shows the fight between bulls and bears. It is not wise to go long because after a hammer, we can only go long by the time that the candle closes. Why? Because this battle between bulls and bears, the bears won't give up that easy and they will fight to the end. It is expected for a dip to come after the hammer, and then it is time to go long. How can we address this? Well, that is very easy. Fortunately, we have the Fibonacci retracement level. We simply measure the length of the hammer. The other way around. Let me show it one more time. The length of the hammer from here to here. Then we use the retracement level to come after the hammer for the perfect entry. So we don't buy at the closing of the hammer. We wait for a retracement. 50% retracement ideally, or even 61.8% will do the trick. And that is a good time to go long. This doesn't work all of the time. Sometimes the market reverses aggressively, and sometimes you just won't find this dip. In Forex trading, the first job of a trader is to manage the risk, to define the risk. Therefore, we must have a stop loss all the time. If we go long here after a hammer candle and we put a stop loss here at the bottom, of course, and we put a stop loss here at the bottom, of course, this will be the risk, the number of pips that I risk. For example, from 119.80 to 119.30, which is approximately 50 pips. Therefore, for sound money management, we must look for a risk-reward ratio, typically 1 to 2 or 1 to 2.5, which is normal for Forex trading. This is the difference between Forex trading and binary options. Binary options traders exult that the brokers offer them 80% or 90% rate of return on their investment, which is a very poor performance. No serious Forex trader will settle for at least 1.5 of the risk. So if we risk 50 pips, based on the volume, that may mean various amounts of money, and we must look for at least 1 to 2 or 1 to 2.5. Therefore, waiting patiently for a pullback and setting a stop loss at the lows, entering at 61.8 to 50% or something like that. So entering here and setting the stop loss for 1 to 2 or 1 to 2.5 risk-reward ratio. And let's assume we go long at 50% retracement. 2.5 or a 2 means this is one time for the take profit. 2 times for the take profit, and 3 times for the take profit. So 2.5 would be somewhere in the middle. 2 would be somewhere around here, and 1 would be somewhere around here. 1 to 1 is not something that I would recommend because the hammer will also be stopped sometimes. But in order to be wrong and still make money, we need a nice risk-reward ratio. Let's look at an example here. This is the Euro-US dollar on the 4-hour chart. Before starting with the example, I would like to mention that the bigger the time frame is, the more powerful the support and resistance level would be. The more powerful the reversal pattern for the hammer would be. So this is a hammer. Do you remember what the first condition of a hammer is? We need to have a strong and powerful bearish trend, and then the market forms the hammer candle. The ones that went long right at the closing of the hammer at 1746, they enjoyed a nice ride to 1776 for 30 pips. Only to see that fortune coming back, and what did the market do? It dipped into 50%, 61.8. The ones that went long here at 50% retracement and placed a stop at the lows and used the 122-123 risk-reward ratio. This would be the risk. Something like this. And if you apply this one, 1, 2, 3, then you are out in no time as the hammer did the job. This is risk management. And this is a simple pattern on the 1 time frame, 4-hour chart for Euro-US dollar. And imagine this example was on a monthly chart and you see the power of trading a hammer as the most interesting candlestick pattern. Of course, the hammer comes after a bearish trend. The opposite is true. We can sell, but not after a hammer. After a similar candle, it is called a shooting star. And a shooting star appears at the end of a bearish trend. The principles are the same. I won't repeat the same information twice then. So let's now move on to the next topic, how to trade the head and shoulders pattern. Bye for now.